Thanks, Luca. And welcome to this talk about the IT infrastructure of an ICO. And so I will really go down into the machine room of an ICO, show you what kind of infrastructure and IT you need, how the smart contracts are structured, and also show you a bit about the actual operations. For example, how you can create the tokens, how you mint the tokens will be one aspect. Quickly, very briefly about my company, Define. We are a consultancy with around now 800 people, 800 consultants. Most of us are physicists and mathematicians. And that makes us, I think, very special. We try to bridge the gap between a typical business analyst role and a programmer's role. And so we do with our blockchain services, so we help with the conceptual design, but we also help with the smart contract programming, setting up the whole infrastructure. And if you believe the Lünendonk list, we are part of the top 10 largest consultancies in Germany. In the blockchain space, we see three different areas we are covering. We focus today in the talk on one of them. So we are helping, for example, banks with enterprise blockchains. For example, we are building a digital platform for one bank in the debt capital markets area. The second column, which was touched earlier this day as well, is about digital asset infrastructure. So we think that we won't live in a completely decentralized world, but there will still be a need for services, and banks will have, and other players will have their place in there. For example, about securely storing your digital assets. And the third column we are looking into and helping our clients is tokenization and ICOs. With respect to the ICO offering we help with the project management, with the conceptual design, how do you design the crypto economics. But the focus in my talk today will be about the smart contracts, the IT infrastructure, and the operations. Quickly, how do we see the different phases, and how long will it take to perform your ICO? So we have heard a few numbers today already, so I won't go into detail here, but it seems that around 5 to 6 months you will need to set up your ICO, and then after that you will have some ongoing support your community, go on exchanges and other things. During the sales and build-up phase, how I call it, you have to tackle at least 5 to 6 different work streams, let's say, you need to cover. And I will quickly tell you what I think are the complexities and the challenges you have to face in each of these 5 work streams. Communication, we've talked a lot about this. I will give you an example later on. Technically, you will have the community, large community, maybe thousands of members in the Telegram group, and they ask questions 24/7. We recommend that you have also some technical measures, for example, Telegram bots that help you with that community. The second work stream is about the actual implementation and testing, from the smart contract to your node infrastructure, to your infrastructure to generate the tokens on the blockchain. You have a work stream around the partner management, basically your external communication with the press, with advisors, with the ICO lists. And here it's important, I think, to have a clear and consistent message over the different channels. Maybe some step back with regards to the implementation and testing. It's really important, I'll show you later why, that you have a very scalable, reliable infrastructure that is also reacting to user requests during high peak times, or as defending against DDoS attacks, as we heard before. And in the end, I think we'll see that there's quite a complex on-chain and off-chain infrastructure you need to maintain. Okay, then there's the legal part. You will have a law firm that helps you with that. And sometimes, for some tokens, you will have some unclarity about the regulation, whether it's a security token or not. And you will need to treat the international coverage and the different regions you advertise your ICO. And finally, I'll get to that later on as well in more detail, is the topic of IT security. What can happen there and what kind of measures can you take against that and to mitigate these risks? And there are two factors. On the one hand side, you have investors that are ill-informed. They may not be very knowledgeable about the blockchain topic and how you handle a transaction, what's an Ethereum address, and so on. And so they make mistakes. They fall into the trap of some phishers. And the second aspect is that actually you have quite a few attack vectors you need to take into account. So this is how a full-blown IT architecture for an ICO looks like. We start in the top left corner. Obviously, you will have your landing page. The investors will go there. They will go through a KYC process, and they will log into their personal dashboard, where they, for example, can order start a buy process, where they see their investments and can perform other actions. On the left-hand side, on the bottom, you see that there will be an investment process. And if you conduct a multi-asset ICO, the investors will have the possibility to invest in multiple cryptocurrencies, but also fiat currencies. So you will need to implement these payment processes to enable the investors, for example, to pay via PayPal. So you will need to integrate it into your dashboard. And all of these transactions, this information on the blockchain, but also about the fiat payment process, and the information about your investors and the information they gave in the KYC process are then gathered in a central database where you store the different kinds of information. And then you might want to have an internal dashboard, basically, that's your window to the outside world, that shows you what is actually currently happening in your ICO. How many investors do you have? What have they invested in which currencies? And then in one aspect is that the whole thing can be connected to your help desk software. For example, it might be connected to Zendesk. So if there's a user request coming in, you can straight away go into your dashboard, see what kind of transaction has this investor made, and help them out maybe with a failing transaction. After or during the ICO, you will do the minting of the tokens, so creating the tokens in the smart contract. And if you perform a multi-asset ICO, it means that you will need FX rates, exchange rates, to determine the correct number of tokens each investor is eligible to. So for example, if you fix the FX rate in euros, let's say you have 100 tokens as €1, that FX rate will be fixed, but then an investor is coming in and paying with Ether, you will need to calculate how many tokens he will receive. I'll show a little bit later how that then can work in detail. And finally, on the right-hand side, top right-hand side, you see the actual contracts. There is here 20 token contract and other contracts. I'll show later more details that actually are they keep the balance sheet of the token holders. Let's go step by step through all the different components in a little bit more detail. Here you see how typically what you have, what kind of smart contract structure you have when you perform an ICO. A lot of the projects, they start with some community standard. So for example, there's an Open Zeppelin library that already provides an implementation, basic implementation of an ERC20 token. You can start from there, and actually it's advised to not reinvent the wheel, but start from that standard that has been tested a lot of times. On top of this community standard, you will have some special things about your token contract that you will need to change. On the other hand, some of the ICOs, they will have a so-called crowd sale contract, and the crowd sale contract is basically has the purpose to enforce certain properties of your ICO. So, for example, what's the minimum investment? When does it start? When does it stop? It's not mandatory. Some other ICOs, they don't have a crowd sale contract. They just give you a wallet address where you send the investments to. Other ICOs use a crowd sale contract. We most of the time use a crowd sale contract. Together with the information about the investments you will have in the crowd sale contract and the information about the applicable rates you have, you can calculate, and other information, you can calculate the number of tokens, start the minting process, and create the right number of tokens in the token contract. The rates contract itself can be some measure of transparency where you store the actual rates that will be applicable for the investors, such that they can see which rate they will get for their investment. On the crowd sale contract side, it's advised that if the investments are sent to the contract, they won't stay there, but they are immediately forwarded to a secure storage. And finally, there will, for many ICOs, there will be a vesting contract, which has the purpose to lock in tokens for the team, for example, for a certain period of time, and will be released over a specific schedule. And these tokens will be released over a specific schedule. So that's the high-level token structure and the tokens you will likely need for your ICO. Quickly go a little bit deeper on actually how the tokens, what does it mean to mint a token in the token contract? And actually it's very simple. The ERC20 token standard just contains basically a mapping between an address and the number of tokens the address is eligible to. And the standard itself defines a certain interface, defines certain functions I can act on, and one of the functions will be the so-called transfer function, where I can send tokens to a different address, and basically everything that happens in this case is that this balance sheet will be changed. So when you do the minting procedure, what you actually do is fill in this balance sheet in the correct way. A few words about the crowd sale contract. What can you do with it? You can restrict investments over time. You can define when your ICO starts, when it ends, but you can also restrict the amount. You can define a minimum amount, you can define a maximum amount. For some processes, and in some ICOs you see that, you can also directly trigger the minting process from the crowd sale contract. So basically immediately as the investment is coming in, the tokens are generated. You can have an emergency pause functionalities. In the case something is going on, you detect a mistake in the contracts or there's some attack, you can pause the crowd sale, or at least the crowd sale contract. And finally, if you have KYC requirements, very likely you have KYC requirements, you will have the possibility to technically make sure that only whitelisted investors can send funds. So much about the smart contract structure you will need. Now a little bit more about the so-called minting process. And here the biggest challenge you will face is to correctly match the investor side, what the information is given on the website, with the actual blockchain transaction, without compromising your security, without having security leaks such that hackers, phishers can steal funds. Another aspect will be to calculate the correct number of tokens, taking into account that there might be several factors that influence how many tokens the investor is eligible to. It could be time, so if you have a stepwise function, you have different bonus structures. You need to take into account bounties or referrals. You need to take into account the time when the transaction happens. You need to take into account the FX rate, so it can get a little bit more complex. And sometimes you're also faced with quite a long operational time. During that, you do the minting process, and even you incur some costs dependent on the number of investors you have. If you have 10,000 of investors, the minting, actually doing the blockchain transaction, can already cost a few thousand euros, and if you do it clever, you can maybe save a factor of 4 or so here. So what can you do? What can you do? What kind of measures do you have to somehow attack these issues? For example, it's advised to approve the target balances and cross-check the target balances before you do the minting. So often in the smart contracts, there's no way to undo the number of tokens you have given to some investor. There are ways you can still do it, but if you don't have that into your contract, you need to really make sure that you actually have the right number of tokens minted. Otherwise, you need to communicate to your community something went wrong. You can, as I said, you can optimize the trade-off between the confirmation time of the minting functionality and the costs you have. So you don't want to wait 1 day to get your minting confirmed. On the other hand, you don't want to spend too much gas in the case of Ethereum to do the transaction. And actually, there might be ways how you can simulate the transactions, how you can cross-check and make sure everything is right before you put it into the main net, into the public net. Yeah. So finally, in the end, you will not be able to give someone their tokens if they don't give you an Ethereum address. That's for sure. And also coming back to the comment earlier on, so you will, if you have a token, and you can start with a paper process in the private sale, but in the end, you will need to have a smart contract, at least the token contract, where you can register them. Otherwise, you cannot use it in your product. You cannot trade it in exchanges. Gets pretty useless. So the fiat payment process is completely separate to the crypto workflow. It just imagine. I mean, the simplest way would be you give your bank details and someone is sending money to your bank account. You register that. There might be some payload on the transaction, some transaction ID, whatever. And then you register that you received money from that investor, and later on you calculate the number of tokens, just mint them on the blockchain. So there is no, currently there's no, let's say, automated way of having a payment process that takes the euros, automatically converts it somehow into tokens. So that's currently two separate worlds.
So in the end, you just need an address for the token on
Yeah.
the network.
Yeah, exactly. And at some point in time, the investor needs to give you that. Otherwise, it won't be possible. And so this also shows that you cannot structure it currently, at least in a way that it's fully trustless. So everything is happening on the blockchain. There's no risk, that there's some fraud happening from the company that's issuing. That's not. I think it's not possible. You can do certain steps that it's less trustful, but for example, take the payment process. Nobody guarantees that you're minting the tokens or not minting the tokens. In the end, the investor needs to trust the company he or she is investing in. So operationally, you can do.
One question.
Yes.
Sorry. So just to clarify, minting here, you mean really giving the tokens as being coded on the chain?
Yes, I can show you. So this is the a simple representation of the ERC20 token contract, and it contains this mapping. And the only thing you're doing when you're minting is basically changing one of the lines in this balance sheet. So there's an address and let's say a balance of 100. And minting basically means that you set that value to 100 because the investor with that address is eligible to 100 tokens. So his address would be in here, and he should have the private key to that public address. So he will be able to access these tokens. He can execute the transfer function, which does nothing else than changing the numbers in this balance sheet. So that's why also it's very important to communicate to your investors that they own the private key to their token, to their address. Otherwise, somebody else will have the private key to that address. Either it's a pusher or it's the exchange. So all the ICOs advise the investors not to send your funds from an ICO, because sometimes, I'll come to that a little bit later, the matching between the investor and the transaction will be done based on the sending address. If the sending address is the exchange address, later on the tokens will also be minted for the exchange address. So you won't, as an investor, won't be able to access your tokens. So that's why it's very important to tell them you need your private key, set up your own wallet, make sure you have access to that. And if you have the private key, you can change these balances. You basically can execute the transfer function and send someone else your tokens.
One question on that. Is it not possible, if you're sending the funds from an exchange address, for example, to include in the data field?
Yes.
Destination address?
Yes, that's possible. So you could in principle, it would be possible that the investor is sending from an exchange address, and then the investor needs to give a different address later on, saying where should the tokens be minted. But as you can imagine,
A lot of human error.
yes. But one of the ways I will show later on, one of the ways to do the matching is via such a payload, some transaction ID. So you don't do the matching via the sending address, but via some other means. But then still the investor will need to give an address where he actually owns the private key.
And a follow-up question to what you just asked about, if the investor purchases using fiat, would you recommend the process to basically convert the fiat to Ether first, and then effectively make all the funding channels consistent, and in the end they all come in via Ether to do the trigger minting?
No, and usually you wouldn't do that. So maybe one remark before that. For the minting, it's not actually necessary that you receive any funds or have Ether or so. I mean, you will incur some transaction costs to do the minting, but that's a separate story. That's a completely separate thing. So minting is independent of what funds you actually receive. It can be euros, it can be Bitcoin, whatever. You don't care for the minting process. You will care later on.
Minting isn't it a consequence? Isn't it a result out of a payment which you make?
Yes. So one of the factors, obviously, that comes into the equation when you calculate the number of tokens that are minted is the amount you receive from the investor, obviously. But it's not operationally in any way connected, exactly. So you can receive the funds, you cannot receive the funds, you can still do the minting. I mean, usually it's a completely off-chain process. You can set the balance sheet in any way you want.
But in the
That's,
slide,
yeah.
2 slides ago, you mentioned that as part of the smart contract, you can have trigger mechanisms.
Yes. So that's an exception. I will show it on the slide later on as well. That dependent on how you do the minting. And in the last case, if you do an on-chain minting process, then it's really a smart contract functionality, and then it's directly linked. Straight through processing. So it's basically an automated process. Yeah.
In that case, then one would transfer money and it would trigger automatically the minting process.
Yes.
As an example.
Exactly. That could be implemented, but there are certain hurdles why I wouldn't recommend to do that. And to come back to your question with regards to exchanging Ether for euros or the other way around, usually the argument here is more, do you want to stay in the exposure of the cryptocurrency? And how much exposure do you want to have there? And if you pay your team in euros, if you pay other stuff in euros, some of the startups look into quickly converting at least part of their holdings into fiat currency. So that's more the
Is actually a good thing from that perspective.
sorry?
Getting paid in fiat is actually a good thing because you don't have the risk.
Yes, yeah. Exactly.
I have one question on this. If you get paid via fiat, how do you transfer tokens to your customer if he doesn't have any kind of wallet?
He needs to have a wallet. So in the end, he needs to give an Ethereum address where the tokens are generated. That's for sure, definitely. But at the point in time where the investor does the investment via fiat currency, he doesn't need it immediately. He will need it later on. When you do the minting, you will definitely need it, yes.
But if you would create the wallet, you will be in control of the public key, which wouldn't make any sense from an investor point.
Sorry?
Just talk.
Normally you provide step-by-step introduction how you can...
Normally, yeah. But this was my question. If you would get paid in fiat money without having your customer and an Ethereum wallet, does it make sense if I go through the complete process?
Then you provide step-by-step like how of that.
How should you set up?
So it's really important that you provide these guides, because there will be investors that haven't done that before, and the more errors your investors will do, the more manual effort you will have later on to help them get a wallet and so on and so on. And so a lot of the ICOs provide instructions. How do you do the investments? How do you, let's say they have a description for my Ether wallet, they have a description for that wallet, and so how do you do it?
Do you have a percentage of your experience, how many customers are trying to pay for fiat? Is there a number you can tell?
Not a specific number, but let's say an estimate. So it really depends on the ICO you're doing and the community you have. If you have a lot of first-time investors, haven't done a crypto investment before, didn't have Bitcoin before, or whatever, you will have a higher percentage of fiat investors. it can be actually, for some ICOs, it can be a very large amount. On the other hand, you might have a blockchain project that's really deep into the community, that's building a new technology stack, that's building a new platform. You could expect that maybe there are more crypto investors. So on this slide, I show you operationally the different ways how the tokens can be generated. Some ICOs they do the whole crowd sale, they gather all the investments, and when the crowd sale is finished, they start the minting process. Disadvantage of this approach is that the investors don't see the tokens on the blockchain until the whole process is finished. And you will have a lot of questions in the channels, where's my token, and so on. The advantage of this is that basically you do it in one go. It's maybe less effort. The second approach is you do it basically in batches. You do, after a few investments, you mint the tokens. You gather further investments, you mint the tokens. And this has the advantage that the users, the investors, get an earlier feedback. They can see their tokens. And also it takes into account that you might have the legal requirement that you redeem the tokens. If you sell the token online, there might be the need that you give back the money 2 weeks after the actual buying process. So you can incorporate that and wait long enough until this phase has passed, and then mint the tokens. And that's also one of the disadvantages of the SDP minting process, when you basically automatically create the tokens, because in this case you cannot take into account this 2 weeks phase. You would need to, you basically need to wait before you can mint the tokens. You can do that SDP process. You can do it off-chain via your regular IT process. You register in your monitoring system that there's a transaction coming in, and you start the minting process automatically. Or you can do it via smart contract logic, and then you can do the minting also on-chain. But you really need to make sure that this process is absolutely bulletproof, or you need ways to make sure that you can do some error correction. Some ICOs that do it like this, they build in some functionality in the smart contracts to undo mistakes. But then, this is also not very nice aspect. A straight-through process, basically meaning that it's automatic and immediately happening. So the other batch processes, they're, let's say, manually triggered. You call some script, the minting is started. While the other process is really, you have a process running, listening to the blockchain, taking each of the transactions, calculating the number of tokens on the fly, starting the minting process, so that the investor immediately sees his tokens on the chain. From a user perspective, from a user experience perspective, that's the nicest one, but also it's the technologically most advanced one.
What's the difference again between off-chain and on-chain?
So off-chain is basically some process happening on the server. You cannot influence as an investor, or you need to trust the startup. It's centralized, exactly. Yeah. Yes, exactly. While the on-chain process, you will have, in the crowd sale contract, you will have a functionality that if there is an investment coming in, you will call automatically the minting function and create tokens in the token contract. So it's ensured by smart contract logic that the tokens are generated.
The whole generation process is decentralized.
Then it's decentralized.
One platform goes on Ethereum.
Yes.
And that will be also publicly ledger.
Yes. Then
Also take
in this case, it will be basically a matter of how long the transaction will need to time to confirm. So in the case of Ethereum, if you spend enough gas, it will be confirmed in a minute or whatever. Yeah. Yes, but in this case, it's borne by the investor. But that's a different thing. Yeah. So this process really gets difficult if you need to take into account the correct FX rates. You have referrals, you have bonuses, and so on. It really gets complicated to do it like this. Okay. So a few more words about multi-asset ICOs and how you take into account the different FX rates. And when the investor goes onto your website, you sometimes see that they are shown a certain FX rate they are getting. But, or at least an estimation of the FX rate they are getting. But then they will go to their dashboard, they will maybe enter an order, they will go back to their wallet and to the transaction. So time passes until the actual investment happens. So the rate the investors will see on the web page is not necessarily the same that the investors in the end will get. So if there's a rate update in the meantime, it could be that it's a different rate. That's why we also sometimes use this rates contract where you can actually see what type of rate is applicable at which timestamp. And you need to, if that's the case and that you do a multi-asset ICO, you will need to explain and show on the website that actually the rate is showing as an estimation, and dependent on the time of the transaction is happening, it might change. So how do you do the matching between the investor and the transaction? And there are several ways, first of all, there are several problems you need to solve. So how do you make sure it's rightfully claimed? It's not claimed by an attacker. How do you make sure that there are only a few errors on the user side? Which wallets do you want to support? Can they support the way you do the matching? And finally, in which way can you reduce the later on manual effort of your team? And there are at least, let's say, 4 ways how you can do the matching, and they can be combined. Some of them are not 100% bulletproof, and you can combine them with others. So the easiest way you can do it, in the Ethereum network, for example, you match it with the sending address. That's what I mentioned before. If the investor enters in the dashboard his Ethereum address, you receive the transaction, you check the Ethereum address of the investors against that transaction, and so you can do the matching. In the Bitcoin case, this is not as easy as like this. In the Bitcoin case, you have much more complicated transactions with several inputs and several outputs. So there's no easy way to do the transaction matching with the sending address. So there is another approach, especially used in the Bitcoin environment, where you do the transaction matching via the receiving address. I will go into that on the next slide, how it works in the Bitcoin case. The third approach we just touched already is you can ask the user to give a payload. You provide him in the dashboard with a certain hash, with a certain number that's specific to a transaction. And when he sends the transaction to you, he needs to incorporate that in the transaction, in the Verwendungszweck, wherever. And so you can do the matching via this payload. And finally, some step you can do additionally to increase the security, but it shouldn't be done solely on that base, you can ask the investors to enter the transaction hash of their transaction in their dashboard, and you can use it as another factor to verify the correct transaction. Let's look into a little bit more detail for the specific case of Bitcoin. As I said, it's not possible easily to do the transaction matching in the Bitcoin case via the sending address, but rather via a receiving address. There's a question.
All those things can't you automate it? I mean, and have your service provider doing it? I mean, this sounds rather, very technical to me.
Yes.
And,
It should be automated, yes. Yeah, so if you do that manually and you have tens of thousands of investors,
I mean, even improving things. I mean, it's
yes. You might have some alerts, you might have some edge cases where you say, okay, I need to look into this and have some manual process, but for the majority, it should be automated. Yeah. Yeah. So Bitcoin. So you do the matching via the receiving address. That means that for every order the investors send, they receive a specific address that's only given to that specific investor. So all the investors send their funds to a lot of different addresses. So you know if some funds are received by a certain address, to which investor it belongs. So in this way you can do quite a secure way of matching the transactions. And there's a technical possibility to do that. It's called HD addresses, hierarchical deterministic addresses. And they basically provide you with means of creating basically a tree of addresses. You start usually, maybe some of you have used a nano ledger, a hardware wallet. You start off with writing down a few English words, 24 words maybe. This is your source of randomness that later on generates a so-called master private key. And then you can build a tree-like structure of addresses and private keys. And this tree you will use to assign to certain investors. The nice thing about the whole technology behind it, there's a certain defined way how you can generate these addresses. It's a mathematical procedure. And you can generate these addresses on an online server, because it can be generated independently of the private keys. So a user says, I want to invest something on the online server. You can, without compromising your security, you can generate a new address. At that point, you don't need the private key. And then on a secure storage, you can have access to these funds via the private key. So that's let's say, to my mind, one of the best ways to do the matching in the Bitcoin network.
And wait, and who holds the private key in this case?
In all the cases, the startup holds all the private keys. Yeah. So with regards to your smart contracts, but also with regards to your investments. A few words about how you can do the transaction monitoring. You might want to see the investors, who has invested how much. You might come from, as I said, you might come from your help desk software, from a Telegram request. You can search through the monitoring system. You can see, okay, this investor has these transactions, and maybe one of the transactions failed. I can click on the transaction and see maybe he didn't provide enough gas, so the transaction didn't go through. so it can help the investor. You can also identify maybe large investors that have a large ETH balance. You can see for which of the investors the tokens have been minted, and so on. So this is basically your window to the outside world, how your ICO performs, how many funds you have collected, and so on. Yes?
There are already a solution existing that provides these investors page and that transactions page.
Yeah, so in our infrastructure that we provide to our clients, this is implemented. Yeah.
Is your own developed solution?
Yes. Yeah. So a few words about IT security. So besides that, let's say the funds you receive and they can be stolen, there are a few other risks that you need to take into account. We have talked about the topic of availability of the website. If there is high peak times or there's even a DDoS attack and your website is not available, it means that the phishers have the chance to attack you, to steer funds to a fake address because your investor communication is impeded, and investors are more likely to go to a phishing site if your site is not working. And also it means that your conversion rate will go down and you will just lose money. So the whole thing should be set up in a scalable way. You should choose a plan that really supports increased traffic and use some DDoS protection for your website. In our infrastructure, we host everything on AWS, on a serverless structure and scalable plans. With regards to phishing attacks, you have that with fake websites, you have that with social media attacks. And that's the point where what you cannot avoid completely. And there will always be some certain percentage of investors that will fall into the trap of a phisher. But what you can do, you can improve, or you can make a very clear communication about how the investment process should work. About, for example, we had that earlier on, you never contact the investor via PM. You communicate it clearly. You communicate clearly that the only valid information is on the personal dashboard of the user. Never use some other sources. So this is a lot about communication, but also you can take a few measures, maybe reserve similar names, reserve on the website and on the social media site. Then smart contracts. Obviously, it's really important. It has been stressed before that the smart contracts are absolutely secure because it means if there's a bug in there, your funds might be lost, or there might be different attack vectors. I will show you in a few minutes how you can make sure that the smart contracts are safe. And also another attack vector is the employees and the whole team itself. So you should make sure that they are really set up securely. So for all the people that, for example, have access to your social media accounts, they should have set up strong passwords. They should have two-factor authentication. You don't want to run the risk that somebody hacks the Facebook account of the startup, posts a fake link, posts a fake address, and you get up in the morning and see that so many funds have gone to an attacker. Okay.
So, one question. Would you also say that the risk that somebody tries to hack me when I try to launch an ICO is 100%? So it is
So what?
that somebody tries to do?
I mean, 100% is a strong statement, but I mean, as soon as you announce the ICO, there will be people around the world that will monitor you and that will try to hack you. Yeah, I mean, yeah, that's the way it is. So you need to be prepared that there will be attacks. So I haven't seen any ICO that hasn't had any attacks. Yeah. So on the smart contract side, you can do 4 things at least. One of them is you start with a community standard. You start with, for example, that Open Zeppelin library that has been tested a lot, and then you start modifying it, but try to keep it simple. Don't overdo it and do too many complicated things if possible. Then you start doing thoroughly testing yourself. You do unit testing, you do integration testing, you do vulnerability testing. And if you have done that, you will also, I would very strongly suggest that you have a security audit firm that checks the contracts again. And finally, a lot of ICOs also do a bounty program, so to leverage the knowledge of the community, and maybe they also find further bugs. A few words about operations of the Telegram channel. Very lucky you have a Telegram channel. And here on the diagram you see an example of a group of around 50,000 users for an ICO. They had around 20 admins around the world to not only do the Telegram but also the other social media channels. And the Telegram channel, if you have such a large community, will create a lot of efforts. And the community and the people really request quick responses here. You see here, for example, that especially at the pre-sale start, at the main sale start, and also at the main sale end, there are really peak times where there are a lot of messages coming in. And you need to prepare for this, to react to this. And if you have such a large community, you will have, every second you will have posts. And at some point, you won't be able to react to everything. And especially, you won't be able to react to phishing attacks manually. Somebody posts a fake address. 5 seconds later, it's off the screen. You have no chance to do that manually. So we advise to use bots to help you with that automatically delete such addresses, that automatically delete links, phishing links, that also automatically delete posts where somebody uploads a file, maybe that will be corrupted with a virus. And you see that in the diagram on the right-hand side, you see that especially then in certain times, for example, before the main sale ends, the attacks increase. And you have, in this case, you have like hundreds of attacks. And yeah, that needs to be handled in an automated manner. It will also be a lot of maybe other projects that try to promote their project in your Telegram channel, and you might not want to have that there as well. So that's the technical operational part. Any questions?